Good morning and afternoon, everyone. Welcome to our bonus depreciation update and cost segregation tax planning webinar. Now, a little bit about our company. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, New York, Texas, Pasadena, California, where our presenter Jeff and myself are located. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. And now I will turn it over to our presenter, Jeff.
So I'm a manager here at KBKG. I'm a graduate from University of Southern California. I do see that we have some Trojans in the audience today. Our football team is definitely turning it around, loving it. I helped develop our cost segregation software at KBKG, and I also have an MBA in finance, and my industry experience is in the real estate industry as well as the engineering and construction industry. And in viewing everyone's welcome messages, seems like we have everyone from across the country here, so it's really exciting. Okay, so as I'm sure you are, we were very excited about the PATH Act and everything that was included within. So the PATH Act, Protecting Americans from Tax Hikes Act of 2015, passed last December, and the last time we had received a change in bonus depreciation rules was the Tax Increase Prevention Act of 2014. So if you remember that, that was basically striking out the old sunset dates and replacing them with new sunset dates for later that year. Taxpayers didn't receive a 2015 extension as part of that act, so taxpayers couldn't effectively plan for future investment, which kind of bugged me because isn't that the reason why bonus depreciation exists, to sort of spur the economy, and so that way business owners and tax planners can invest into some, in our case, real estate or build out, and then being able to deduct half of that or whatever the bonus rate would be in that year. So we've always sort of followed a plan of being extended, and then that bonus depreciation benefit would be retroactively activated. And so in the case of the PATH Act, this gives us a ground or a roadmap for taxpayers and business owners to plan for the future. So we can now follow and plan accordingly for the next 4 to 5 years. As we'll discuss, bonus depreciation will slowly phase out, and all that was included in the PATH Act from the depreciation perspective was the extension of bonus depreciation through 2019, the permanent implementation of qualified leasehold improvements, qualified retail improvements, and qualified restaurant property provisions. We'll discuss a little bit on the definitions and criteria about what makes those qualified real property qualified for bonus. The PATH Act also introduced a new category of qualified real property called qualified improvement property. Now, I know that we generally throw around a lot of acronyms out there, so I'm going to try to stay away from the acronyms, so it might sound a little bit annoying, but for those that aren't too familiar or don't use these terms too often, it might be confusing if I go by QLI or qualified retail improvements or the new category QIP, which sounds kind of funny anyway. So with all this excitement, please note that bonus depreciation rules are generally the same, and those detailed rules can be found in IRC Code Section 168K, which was released way back in 2001. So that code section has been updated, but it's the same section that we've had. So let's recap a little bit on those regulations under 168K. In order to properly qualify for bonus depreciation, a series of criteria must be met. So the property must be of a specific type, and we'll get into that detail on the next slide because there are many different types which we sort of glazed through on the previous slide. The property must be of original use, so that's new construction. If the property cannot be purchased secondhand, although we'll get into an example of when acquired property can qualify for bonus. But basically, original use is renovations, a tenant build-out, ground-up construction, all that type of activity. Okay, so the next bullet point is the acquisition of property. So the property must have been acquired by the taxpayer after December 31st of 2007. So this goes back to the old written and binding contract rules, if you remember those, and we'll touch up on a couple of slides regarding that. Now, the property must also be placed into service during the applicable bonus windows. So those periods we'll get into in a couple of slides, but for the most part, since when bonus was at its high of 100% in 2011, since then we've enjoyed a stable rate of 50%, but all of that is going to change, and all of that is going to change because of the PATH Act. Okay, so here's a listing of specified property which will qualify for bonus depreciation. Now, everything looks pretty similar to the past, and basically it is, with the exception of the addition of another new category called qualified improvement property. Now, we'll get into the definition of qualified improvement property shortly, but at this point, just be aware that qualified improvement property is a bonus depreciation eligibility, and that replaces the more specific qualified leasehold improvement property. So it's a provision for bonus depreciation. And as a recap for bonus eligibility rules, remember that any maker's property with a GDS recovery period of 20 years or less is generally eligible for bonus. So that includes personal property with a recovery period of less than 20 years. It also includes site improvements, which are generally depreciated over 15 years. A lot of taxpayers don't necessarily think of land improvements such as landscaping and asphalt paving as being bonus eligible, but that does qualify as well. Certain water utility property and certain computer software is also eligible for bonus. And then there's long production period property, which we can get into in a further slide down the way. Qualified property is not qualified restaurant property, and in the past, qualified retail improvements as defined in the regs. However, we'll see that qualified retail improvements, because of the PATH Act, actually also received a change, not only becoming permanent, but they do receive bonus now. And then anything that's required to be depreciated using the alternative depreciation system is not eligible for bonus either. This next slide shows some bar charts as far as what bonus depreciation will look like from 2012 and onward. Obviously, we're in 2016 right now, and as mentioned before, we've been enjoying a stable 50% bonus rate. But as you see from the second bar from the left, in 2018, bonus will actually go down and the rate will be at a 40%. In 2019, it will go down another 10% to a 30% bonus rate, and then bonus sunsets in 2020. And for those that like to read the slides as I go, you'll see there's an asterisk that you can receive 30% bonus for long production period property in 2020. So that's the benefit of long production period property, and we'll get into more details on that. But for now, just know that bonus is decrementing as we look towards the future. Now we've seen bonus go away for periods of time, and it's come back. So, all of this, of course, is subject to change, especially with the new election of the president and all of that stuff. But as of now, this is what our plan is going to be. So let's get into the different types of real property that have special benefits that either attribute a shorter depreciable life or bonus eligibility, or both. Now we'll talk about qualified leasehold improvement property, qualified improvement property, the new one, qualified restaurant property, and qualified retail property. Okay, qualified leasehold improvements. So even though qualified leasehold improvement verbiage was replaced with the qualified improvement property in the PATH Act, be aware that qualified leasehold improvements are still around. They've been permanently extended and will have a 15-year depreciable life. So additionally, by definition, everything that meets a qualified leasehold improvement also meets qualified improvement property. So they are bonus eligible. Qualified leasehold improvements you can think of as a subset of qualified improvement property. And so what makes a leasehold improvement a qualified leasehold improvement? It's any Section 1250 property that's an improvement to a non-residential real property and must be for an improvement to the interior portion of the building occupied exclusively by a lessee. So in other words, the improvement cannot be for a common area that's shared among several tenants to receive a 15-year life, but that piece in this example could still receive a 50% bonus depreciation if it was placed in service more than 3 years after the building was first placed in service. An example of that would be constructing a leased space in a historic office building, which would meet the age requirements where the building out the same space in an office tower built last year. So there is some time frame eligibility here. So again, that's exclusively for the 15-year life treatment and not the bonus eligibility, because in that example, both would be bonus eligible due to the qualified improvement property category. So qualified leasehold improvements must be made pursuant to a lease between unrelated parties, and we'll have an example of what is a related party and what's unrelated. And please note that the lease cannot be between two of these related parties, and you can make the determination of that using Code Section 1504 or by applying an 80% threshold test, which took the place of a 50% test in Code Section 267. Essentially, if there's an 80% common ownership in both entities, then that's what's considered a related party. And like I said, we'll get into an example in 2 slides from now. So the exclusions for qualified leasehold improvements are any costs related to the enlargement of a building, costs for elevators and escalators, common areas, which we mentioned earlier, do not meet the definition of qualified leasehold improvements, and then finally, costs that are related to the internal structural framework of a building are excluded. Now, many taxpayers and preparers make the mistake of claiming qualified leasehold improvement benefits on all tenant improvements that they pay for. On depreciation schedules, sometimes I often see one line item that says leasehold improvements and the life being 15 years. And in engaging with a cost segregation study, looking at the detail, there's a lot of items in there that are incorrectly classified as qualified leasehold improvements, which can either be personal property, 5-year on the good side. On the more negative side, sometimes there are structural items in there, like maybe steel beams and girders, or something that would uphold the frame, such as like a truss or roofing, and all of that would not be a qualified leasehold improvement, and those should generally be depreciated over the life of real property, which is 39 years, or in the case of residential rental property would be 27 and a half years. So a lot of those items that don't qualify are listed in the bottom half of the slide. So if you're seeing those types of costs in the invoice detail that your client is giving you, there's a good chance that they're not qualified leasehold improvements. Okay, so related parties. Let's run through an example of how all this works out with some help from another set of Pasadena-based cast of characters. Big Bang Theory, for those that aren't too familiar with America's most popular show, I guess. Penny and Leonard are business owners, both equal 50-50 in a research and development business called Bazinga. Now, they lease the space from a real estate holding company called TBBT LLC, Big Bang Theory. So TBBT has an ownership structure consisting of 35% to Penny, 35% to Leonard, 20 to Sheldon, 5 each to Raj and Howard. So in this instance, TBBT has a 70% common ownership with Bazinga, and that's both Penny and Leonard's 35%. And since the unrelated parties rule requires an ownership percentage of less than 80%, the office space would then meet the criteria to receive the 15-year life treatment of qualified leasehold improvement, so any improvements that they do to the property or to their space. Now, additionally, if the scope of work completed meets the definition of qualified improvement property, then bonus depreciation is applicable too. So let's say that they were related, but if it met the qualified improvement property, then they would receive bonus. It just wouldn't receive the 15-year treatment. So as mentioned earlier, qualified improvement property is a bonus provision. So as bonus sunsets, as we saw in the slide with the bar charts, let's say it's 2020, and you make a qualified leasehold improvement, well, as a qualified leasehold improvement, you'll get 0% bonus depreciation since that went away, but you will get the 15-year life. So that's why qualified leasehold improvements, that's why the benefit of having them be permanently extended still helps taxpayers, because you're looking for the 15-year tax recovery period and not the bonus rate. Okay, so the new category, qualified improvement property. What exactly is it? So it's very, very similar to qualified leasehold improvements. It will just affect a broader amount of taxpayers. So some of the criteria is loosened up, and more taxpayers can enjoy bonus depreciation because of this. So qualified improvement property is an improvement to the interior portion of the building if such improvement is placed in service after the date the building was first placed in service. So the property must be placed in service after 2015, so it's a 2016 provision. It can be made to a common area. It does not have to be made pursuant to a lease, and the property does not have to be 3 years old. So this is tricky, as theoretically somebody could place a building shell into service in January of 2016 and then place the build out into service in July of 2016, and then that build out would meet the qualified improvement property definition and receive a 50% bonus, rather than placing both the building and improvements into service in either January or July. So remember, it has to happen after the building was first placed into service. Also, you can see qualified improvement property is still depreciated over 39 years using the mid-month convention, but bonus depreciation is now eligible. So we can have this as an example of an acquired property too. So let's say that your client acquired a property in 2014 and is now making improvements or renovations to the interior in 2016. So in that case, qualified leasehold improvements wouldn't be applicable because it's less than 3 years old, but qualified improvement property then steps in there. Okay, qualified restaurant property. Now notice that this doesn't say qualified restaurant improvement property. So the fact that it's missing the improvement is kind of a bit of a key for a qualified restaurant property. So similar to qualified leasehold improvements, qualified restaurant property has also been permanently extended. One thing that's really interesting about restaurant property is that it can be acquired property. And so notice the fact that improvement is missing from there, as I said. Now, in order for a property to meet the requirements of qualified restaurant property, at least 50% of the building square footage must be devoted to the preparation of and seating for on-premises consumption of prepared meals. I love that definition. So let's imagine that you have a strip plaza, as seen in this picture in the lower right. Now, let's say that all the tenants have equal square footages and there's 5 tenants each. Now, if 3 of the 5 tenants are restaurant property, like a Subway, a Pizza Hut, and let's say a burger joint, are in that plaza, then that whole building itself is considered restaurant property and will have a 15-year life. So also remember, an improvement to qualified restaurants can meet the definition of qualified improvement property too, and then they overlap and receive bonus and the 15-year life. So you will get a double bonus if it's qualified restaurant property and you have improvements that meet the definition of qualified improvement property, because qualified restaurant property does not get bonus, and that's part of their definition. Okay, qualified retail improvements. This is very similar to qualified leaseholds, but basically it can be owner-occupied. Going 2016 onward, the improvements don't have to meet the definition of qualified leasehold improvements for a bonus. So you can have related parties in there, or just meet the criteria of qualified improvement property. Now, the definition of retail is those 2 indented bullet points. If such portion is open to the general public and is used in the general trade or business of selling tangible personal property to the general public. So one thing that you may question is like a fitness gym. Well, they're not really selling tangible personal property. So, I mean, you can make the argument that, yeah, there's some Gatorade and things like that in there, but it gets a little tricky as to what your client is and if that falls into retail. So just something to keep in mind. Let's get into some nuances of the bonus requirements. Now that we've covered the general rules, we'll go beneath the surface and examine some of the details behind some of the requirements. So as with most aspects of the tax code, there can be various issues that pop up as we look at implementing these benefits. So we're going to talk about our qualified improvement chart, self-constructed property. We'll get into the written binding contract. So that's really regarding the acquired property. We'll talk about long production period property, and then we'll get into some planning considerations and strategies to think about. So included in the handout, and what's always generally refreshed on our website, is what we call the qualified improvement chart. And so this chart lists out the various categories of property, the ones that we had just talked about: qualified leasehold improvements, qualified retail improvements, restaurant property, and then the new category, qualified improvement property. It shows the place and service dates that you would need to fall into for these to take effect. Notice that there are more than one definition or criteria for something like qualified leasehold improvement. And then, as mentioned earlier, qualified retail improvement property had a little bit of a change in 2016, in the fact that it does get bonus now, and some other aspects too going forward. So this chart also shows the criteria, such as if it's bonus eligible or not, whether the 3-year rule applies, whether the related parties rule applies, and then 179 expense eligibility. And as with all things tax, there's a bunch of footnotes. So this slide is actually a snippet of a 2-page handout that I recommend, printing it out, forwarding it on to staff and even clients. I have one that I'm staring at right in front of my desk, and so this gives you the definitions of everything in there, and it also gives you the code section if you like to delve into the nitty-gritty of the tax code. Okay, so the next topic is self-constructed property. If you or your client is a landlord, retailer, professional services firm, or anyone that leases a property, this probably applies. So self-constructed property is fairly simple. It's, as common sense, it's any property that's constructed by the taxpayer themselves, or it can be property constructed for the taxpayer by another person under a written binding contract, as long as that contract was entered into prior to the start of construction. So as long as you sign the contract before construction begins, it's considered self-constructed property. And when you're dealing with self-constructed property, it's not subject to the written binding contract rules that you'll find in the bonus depreciation regs, but it will be subject to certain other rules in terms of knowing when construction began. So when construction begins, the self-constructed property is what's going to dictate your bonus depreciation rate and your bonus depreciation eligibility. Now the rate, as I've continually mentioned, hasn't changed a lot for the past 5 years, but going forward, as bonus sunsets, we are going to see more examples where the rate will actually matter. Again, like in 2018, it's 40%, 2019, 30%, 2020 goes down to 0. So self-constructed property is the most common and probable situation that you're going to come across. Now, it's important to understand the differences between acquired and self-constructed property. So according to the bonus regs under 168K, an example of acquired property would be to include a situation where a developer started construction of a spec property. A taxpayer could sign a contract to acquire after construction has begun, but not yet completed, and this property would still be eligible for bonus. This is subject to the written binding contract rules. So the date when construction to acquire is executed is critical to the applicability to bonus depreciation. So with self-constructed property, the taxpayer signs a contract to acquire the property before construction commences. So the date of the contract is not as relevant for bonus. However, there needs to be consideration of when construction work of significant nature is completed, and within the bonus regs there's a 10% safe harbor rule that helps you determine when construction has officially began. So let's get into 2 examples, an acquired example and then self-constructed example. So in this acquired property example, the developer begins construction of a building in November of 2017 and expects it to complete in 2018. Now, the taxpayer signed a written binding contract after construction began on November 28, 2017. And let's say the property was placed in service in 2018. Now, if a cost segregation study was done, all of the short life property items would be eligible for 50% bonus depreciation and not 40%, because the written binding contract was signed before 2018. So this is considered acquired property because ownership happened in 2017. Note that if this was self-constructed property, a significant portion of this amount could only be eligible for that 40% bonus. So as we flip it and go to a self-constructed property example, let's say that the written binding contract is executed in March of 2017. Now, construction starts on November 1st of 2017 and is completed and placed into service in July of 2018. Now, since this is considered self-constructed property, the contract to acquire was executed before construction even began, then we look at to when physical work of significant nature, which we'll get into in a second, and the place in service criteria. So the place in service date was in 2018, so all of the costs would meet the 40% criteria and not the 50%. Okay, written binding contract rules. Now, these rules are applicable to acquired property only. You can look at the regs for detailed guidance on the definition of a binding contract, but in general, a contract is binding only if it's enforceable under state law against the taxpayer and does not limit damages to a specified amount. There's a 5% rule. Even if it's considered binding even if it's subject to a condition. A contract will continue to be binding even if parties make substantial changes in its terms and conditions. So for planning considerations, if a taxpayer signs a written binding contract after construction begins, you should look to see if there's any substantial changes that were made to the contract during a bonus eligible period. So of course, this example is more a future type example for planning, as our bonus rate will change. As it's been steady at 50%, this example may not necessarily come up, but keep this in the back of your mind as we switch in a year from now from 2017 to 2018. Now, when does construction officially begin? So when dealing with self-constructed property, we have to look at when it begins. The definition within the regs is called when physical work of significant nature begins. And so what is that? Well, there's a safe harbor rule that helps you with this factual determination. Physical work of significant nature occurs after taxpayers pay or incur more than 10% of the total cost of the property. These costs exclude land and preliminary activities listed there, such as planning, designing, initial clearing. So for accrual-based taxpayers, even if they didn't pay the 10% cost, but 10% of construction is completed, then you can consider construction to have begun. Documentation of this is critical and is typically done when relevant as part of a cost seg study. Okay, one more slide before question 2. Maximizing bonus depreciation using cost seg. So speaking of cost segregation studies, remember that the goal of a cost seg study is to reclassify a substantial portion of the building component into shorter tax lives of 5, 7, 15-year depreciable lives. So by doing so, you're making those identified costs bonus eligible. As we recall, one of the criteria is maker's property of 20 years or less. So anything you identify as less than 20 years will be bonus eligible. you'll know that you're taking full advantage of the bonus rules. You're identifying all those components that are eligible. So construction activities that include special process piping and fixtures within the building that are accessory to the business would be bonus eligible. Certain finished carpentry and millwork within the building, as well as special electrical connections, would also be bonus eligible. So as CPAs or tax preparers, oftentimes we'll have a one line item with the purchase price for the construction that says building 39 years. As we go through a cost seg study, that line item will be broken out into multiple lines, hopefully with a lot of the cost basis being into shorter life line items. And if those lives are less than 20, then they would be bonus eligible. Okay, long production period property. So it's property that has a recovery period of at least 10 years, or also certain transportation equipment also qualifies. It's property that's subject to 263 Cap A and has a production period exceeding 1 year and cost exceeding $1 million. So just think of it as simply what it's named after. It's an expensive, long production period type of improvement. So notice that qualified leasehold improvements can fall under long production period property. Basically, the benefit of it is a 1 year extension of the bonus rate that was in the prior year. So again, as we've enjoyed a 50% stable rate, long production period property has kind of hidden itself for a while. It was really popular back in 2012 when the 2011 bonus rate was 100%, and people still wanted that 100%. So now that bonus is going to be decrementing and sunsetting in 2020, long production period property might rear its head again. So just know that the eligible basis is the lesser of the payments made or the percent completed by certain dates. So a little bit more about this is the RevProc 2011-26 includes guidance that's related to long production period property and the applicability to the 100% bonus depreciation. So similar to what I was mentioning before. But we'll have to reference that RevProc until something new comes along. But extrapolating the guidance within that RevProc is basically our inference that long production period property started in 2017 and can still have a 50% bonus rate as long as the entire basis and it's placed as long as it's placed in service by the end of 2018 and it meets the other definitions such as the $1 million basis. So this is the same case through 2020 with different percentage allocations. So remember that bar chart slide that we had shown earlier? Well, here it is again. And notice in back of the green bars are some maroon bars that basically shadow the bonus rate. So we look at the second bar to the left, the 2018 bar, we'll see that the bonus rate was at 40%, but the long production period property is at 50%. And then in 2019, the long production period property then is at 40%. And finally in 2020, when normal bonus reaches zero, long production period property still allows you for a bonus rate of 30%. Okay, some planning considerations. Note that everything we just discussed is for federal tax purposes and that every state is different. Many states have not historically conformed with the federal bonus depreciation. Some states disallow bonus entirely. Some modify the calculation. Also note that many states don't provide a 15-year tax life for qualified property. So that chart, so you'll have to make sure your state is in line or what the changes are. Many states are still trying to figure out what they want to do going forward, so just keep that in mind. And with all of that in mind, please don't dismiss a cost segregation study if your state does not follow federal rules. You know, there's still benefits to be had on the federal side. And again, the cost segregation study, even if you don't get bonus, you're reallocating property from 39 years to potentially 5 years. So that would be like an 8 times multiplier as far as accelerating depreciation goes. Or even reclassifying 39-year to 15-year is, you know, a little bit more than double. All right, everyone. So we're in the home stretch. 10 minutes left. So let's talk about some recent developments in case law. I'm sure you've all heard about the final repair regs, which were released in September of 2013 and were made effective of January 14. So I'm just going to reiterate some of those topics, as that was an accounting method change, and you should be able to go through those analyses annually. Also want to mention some other accounting method related issues to think about. So the repair regs, as the buzz phrase was coined, we have a separate webinar dedicated exclusively to those. I believe it's a 2-hour special, so strap in for that one. The regs talk about a unit of property. So for a building, which is what we'll focus on since this is a cost segregation-centric webinar, has 9 separate building systems: electrical, plumbing, HVAC, building shell, elevator, security. Well, they're all depreciated over the same 39 years. For repair and maintenance purposes, an analysis must be completed at the unit of property level. So it's most advantageous for a taxpayer in the long run to componentize and segregate their properties on the front end by completing a cost segregation study. That way, it also helps for dispositions. The unit of property analysis that must be completed is referred to as a bar test. So you must ask yourself, did my expenditure create a betterment to the unit of property? For example, being an increase in energy efficiency in electrical system. Did it adapt to the unit of property? That would be the A. Or was a restoration performed to the unit of property? So that's bringing that property back from a state of repair. If it meets any of those bar criteria, then it must be capitalized. And if it fails all of those, then you may be looking at a repair or maintenance expense. Now we'll get into a partial disposition. Well, we get to the partial disposition, and this may be the biggest thing that might benefit taxpayers the most, because the regs say that the removal of a structural component of a building is now a disposition. So you can write off the remaining basis of 1250 components as they're demolished. Now let's run through a quick example. A client spent $3 million on renovations in 2009. They capitalized and depreciated the entire amount. KBKG's review of the invoices included work done portions to the roof, HVAC replacement units, and so after we do a unit of property analysis, we identified $350,000 worth of costs that actually should have been repair deduction. So the client realized an additional $328,000 in that current tax year. Now, the retirement of structural components that I mentioned, here's an example of that. A client acquired a $5 million property in 2010. Last year, they spent $1 million remodeling a portion of the second floor. Now, when the retirement study determined that the original cost basis of the demolished components was $470,000. So that recognized that client recognized the loss of $404,000 in that current tax year, 2015. Now note, you can't go back and do retroactive late partial dispositions anymore. That expired in 2014. You can still have dispositions, and you can still have partial dispositions, but they just have to be done in the current tax year. So if your client had acquired the building and retired components based on 2016 improvements, then you can still have these retirements or retirement study done. Some common changes some changes for some common accounting methods. You guys can read this list here. Some of the notable ones are the disposition of the building that we just talked about. So that's change number 205. Late partial dispositions, as I mentioned, was 196, and so that one kind of expired. The repairs are 184. You guys can review that slide. We also have a handout of these changes listed on our website too. So similar to where you'll find that qualified real property chart, you'll also find this change in accounting method chart. So in wrapping up, and before our next and final polling question, you want to ask yourself, what are the real capabilities of the cost seg provider you're using? So there's been significant changes. There hasn't been like a lot, but there have been large in scope type changes of what makes the industry landscape now. The value of a cost seg is not just about breaking down a building into components. We now have repairs, maintenance costs. We now have future value of retirements, potential retirements. So just know that smaller providers may not have the resources to stay on top of it all. You also want to make sure that energy credits, is there 45L, or there's also 179D, green energy deductions. What are some property tax issues, tax considerations of cost seg? So you want to ask yourself that when considering a cost segregation provider.